The backdoor Roth IRA is often described as a secret tax loophole for high-income investors, but it is neither a secret account nor a magical way to avoid every tax. It is a sequence of two ordinary transactions. First, an eligible investor makes a non-deductible contribution to a traditional IRA. Then, that money is converted into a Roth IRA. The strategy exists because the income limits that restrict direct Roth IRA contributions do not generally prevent Roth conversions. That sounds simple, and for someone with no other traditional, SEP, or simple IRA money, it can be relatively straightforward. But when pre-tax IRA balances already exist, the pro-rata rule can turn what looks like a tax-free conversion into a partly taxable transaction. Investment gains, incorrect reporting, and year-end rollovers can create additional complications. So the real question is not whether the backdoor Roth IRA still exists in 2026. It does. The better question is whether the future benefit of Roth treatment is valuable enough to justify the taxes, reporting, and account restructuring required in your situation. For the right high-income investor, the backdoor Roth can create years or even decades of potential tax-free growth. For someone who can still contribute directly, has a large pre-tax IRA balance, or has more urgent financial priorities, it may provide little benefit. In this video, we will explain every step, calculate the pro-rata problem, and identify when the strategy remains worth using. And the first step is determining whether you actually need the backdoor at all. The backdoor Roth IRA is primarily relevant for investors whose income is too high to make a regular direct Roth IRA contribution. For 2026, a single taxpayer or head of household can generally make the full direct contribution when modified adjusted gross income is below $153,000. The permitted contribution is gradually reduced between $153,000 and $168,000. At $168,000 or more, a direct contribution is generally unavailable. For married couples filing jointly, the full contribution is generally available below $242,000. The phase-out range extends from $242,000 to $252,000. At $252,000 or more, direct Roth contributions are generally unavailable. The key word is direct. These income limits restrict the contribution going straight into the Roth IRA. They do not generally prevent an investor from converting traditional IRA money into a Roth. That difference creates the backdoor Roth opportunity. But an investor below the income limit normally does not need the extra steps. A regular Roth contribution is usually simpler, creates less paperwork, and avoids the possibility of making an error during the conversion process. Income above the limit also does not automatically make the backdoor attractive. The investor must still have eligible compensation, available contribution room, and a financial plan that supports retirement saving. Most importantly, the investor must examine every existing IRA balance before proceeding. Once direct eligibility has been checked, the next step is understanding exactly how the two-part transaction works. The backdoor Roth IRA normally begins with a non-deductible traditional IRA contribution. Non-deductible means the investor contributes after-tax money and does not claim an income tax deduction for that contribution. The money initially enters a traditional IRA because the investor is not eligible to contribute directly to the Roth IRA. The second step is a Roth conversion. The investor moves the traditional IRA money into a Roth IRA. After the conversion is completed, the money can be invested according to the investor's retirement strategy. The contribution and the conversion are different transactions. The contribution uses the annual IRA contribution limit. The conversion does not create a second contribution limit. An investor could also convert more than the current year contribution amount when other pre-tax IRA money exists. But pre-tax money and investment gains included in that conversion may be taxable. Timing can affect the result. When the non-deductible contribution remains in cash and is converted before generating meaningful gains, the taxable income may be minimal, assuming no other pre-tax IRA money exists. When the contribution is invested and rises before conversion, the gain is normally pre-tax. That gain can become taxable when converted. This does not mean investors must convert on the same day or follow an artificial waiting period. It means the tax result depends on what happens between the contribution and conversion. After the money reaches the Roth IRA, it still needs to be invested. The backdoor Roth is the entry process. It is not the investment strategy itself. With that mechanism established, we can now define how much money can enter through this process in 2026. For 2026, the combined annual contribution limit across traditional and Roth IRAs is $7,500 for someone under age 50. An investor age 50 or older may contribute up to $8,600, including the catch-up contribution. The word combined is important. The limit is shared across traditional and Roth IRA contributions. It is not $7,500 for each account. A high-income investor using the backdoor Roth strategy may contribute $7,500 to a traditional IRA and then convert that money to a Roth IRA. That uses the annual IRA contribution limit. The conversion does not use another $7,500 of contribution room. The amount converted can sometimes exceed the annual limit. Suppose a traditional IRA contribution grows from $7,500 to $7,600 before the conversion. The investor can convert the entire account. The contribution remains $7,500. The additional $100 represents investment growth and may be taxable. The investor also needs enough eligible taxable compensation to support the contribution. Opening multiple IRA accounts does not multiply the limit. A contribution made at one brokerage and another contribution made elsewhere are still added together. For married couples, each spouse has an individual limit and must use a separately owned IRA. The backdoor Roth does not create additional contribution space. It only creates an alternative route into the Roth IRA when the direct route is restricted. And although the contribution uses after-tax money, that does not guarantee the entire conversion will be tax-free. The next slide explains why. A backdoor Roth conversion can create little or no taxable income when the investor has a clean IRA situation. Imagine an investor contributes $7,500 of after-tax money to an empty traditional IRA. The contribution is reported as non-deductible. The money is converted shortly afterward before producing meaningful investment gains, and the investor has no other traditional, SEP, or simple IRA balances. In that simplified situation, most or all of the conversion may represent after-tax basis that has already been taxed. The tax calculation considers the relationship between after-tax basis and the total value of the investor's eligible IRAs. That is the pro-rata rule. Investment gains can also create taxable income. If the original contribution is non-deductible, earns $100 before conversion, that $100 has not previously been taxed inside the IRA. Converting it generally creates taxable income. The important distinction is between basis and untaxed money. After-tax basis should not be taxed again when correctly tracked. Pre-tax contributions, deductible contributions, and investment gains are generally taxable when converted. Calling the original contribution non-deductible does not automatically make the entire conversion tax-free. The decisive factor is the composition of all the investors' eligible IRAs, and that brings us to the rule responsible for most backdoor Roth surprises. The pro-rata rule prevents an investor from converting only the after-tax dollars while leaving all the pre-tax money untouched. For tax purposes, eligible IRA balances are generally treated as one combined bucket. Consider a simplified example. An investor has $90,000 of pre-tax IRA money. The investor then contributes $10,000 of non-deductible after-tax money. The combined IRA value is $100,000. 10% of the account represents after-tax basis. 90% represents pre-tax money. Now suppose the investor converts $10,000 to a Roth IRA. The conversion is not automatically treated as the $10,000 of after-tax money. Instead, approximately 10% or $1,000 may be considered non-taxable. The remaining $9,000 may be taxable. The calculation is simplified here, but the central principle is accurate. The non-taxable percentage is based on after-tax basis divided by the relevant total IRA value, with the applicable distributions and conversions included in the calculation. This is why a small backdoor Roth contribution can create an unexpectedly large taxable portion when substantial pre-tax IRA assets already exist. The investor is not being taxed twice on properly documented basis. The investor is being taxed on the proportion of converted money that represents untaxed IRA dollars. Understanding this rule before making the conversion is essential, but it raises another question. Which retirement accounts are included in that combined bucket? Traditional, SEP, and simple IRAs generally matter. Many workplace retirement plans generally do not. The pro-rata calculation generally aggregates the investor's traditional IRAs, traditional SEP IRAs, and traditional simple IRAs. It does not matter whether those accounts are held at one financial institution or spread across several brokerages. Moving an IRA from brokerage A to brokerage B does not make the old balance disappear from the tax calculation. The accounts still belong to the same taxpayer and are generally viewed together. Workplace retirement plans are treated differently. Balances inside a 401k, 403b, governmental 457b, or thrift savings plan generally are not included in the IRA pro-rata calculation. This difference creates a potential planning opportunity. An investor with pre-tax IRA money may be able to roll eligible assets into a current employer's 401k, assuming the workplace plan accepts incoming rollovers. Once the assets are properly inside the workplace plan, they are generally outside the IRA aggregation used for the backdoor Roth calculation. But this is not automatically a good move. The workplace plan may have higher fees, limited investments, or restrictive rules. Some plans do not accept IRA rollovers at all. An investor also needs to confirm which assets are eligible to move and how after-tax bases will be handled. The key point is that account type matters more than account location. 3 traditional IRAs held at 3 institutions generally remain one combined IRA bucket. A traditional IRA and the 401k generally do not. That distinction can determine whether the backdoor Roth conversion is mostly non-taxable or mostly taxable. There is also a timing issue that surprises many investors. The pro-rata calculation can be affected by the IRA balances that exist at the end of the calendar year, even when the conversion occurred months earlier. Investors sometimes assume that their IRA situation is measured only on the date of the Roth conversion. That assumption can create an unexpected tax bill. The pro-rata calculation uses relevant IRA information for the conversion year, including the value of traditional, SEP, and simple IRAs at the end of December 31st. Consider an investor who completes a clean backdoor Roth conversion in February. At that moment, the investor has no other pre-tax IRA balances. The transaction appears straightforward. But later in the year, the investor leaves a job and rolls a large pre-tax 401k balance into a traditional IRA. If that money remains in the traditional IRA on December 31st, it may affect the pro-rata calculation for the conversion completed earlier in the same year. The early conversion did not permanently lock in a clean tax result. The year-end IRA position still matters. This is why investors should evaluate expected rollovers, SEP IRA contributions, and simple IRA balances before completing the annual strategy. A late-year business retirement contribution or workplace plan rollover can materially change the calculation. The year-end rule also explains why moving pre-tax IRA money into an eligible 401k may need to be completed before December 31st to affect that year's ending IRA balance. Transaction processing times and plan rules should be considered well before the final days of the year. The correct approach is to review the entire calendar year, not only the day money moved into the Roth IRA. And because the tax authority cannot see the investor's intentions, the contribution basis and conversion must be documented properly. That documentation centers on Form 8606. Before we get there, this is the right point to reinforce the channel's broader approach to retirement strategies. If you prefer retirement analysis without calling every tax technique a secret loophole, subscribe to Boring Money Wins. The Backdoor Roth IRA is not valuable because it sounds sophisticated. It is valuable only when it improves the investor's long-term tax position after accounting for current taxes, reporting requirements, and the rest of the financial plan. For someone with no pre-tax IRA money, the process may be relatively simple. For someone with a large traditional IRA, the same transaction can create a significant taxable conversion. The difference is not the name of the strategy. The difference is the account structure behind it. If this explanation is helping you understand the taxes before moving the money, click the like button. That helps YouTube recommend the video to more investors who need practical retirement guidance instead of oversimplified instructions. The goal is not to discourage the backdoor Roth. The goal is to prevent investors from completing the contribution and conversion while ignoring the pro-rata rule, year-end balances, and required reporting. A correctly completed strategy can create valuable Roth assets for a high-income household. An incorrectly documented strategy can lead to double taxation, penalties, or years of confused tax basis. The transaction may happen at a brokerage, but the final result is determined on the tax return, and the document connecting the non-deductible contribution to the Roth conversion is Form 8606. Form 8606 creates the tax record for non-deductible IRA contributions and Roth conversions. When an investor contributes after-tax money to a traditional IRA without claiming a deduction, that contribution creates basis. Basis represents money that has already been taxed. It should not be taxed again when distributed or converted, but the basis must be tracked. Form 8606 reports the non-deductible contribution, calculates the taxable and non-taxable portions of distributions or conversions, and carries unused basis into future years. Imagine an investor makes a non-deductible contribution this year, but converts only part of the IRA. Some basis may remain and need to be carried forward. If that basis disappears from the tax records, a future conversion could be treated as more taxable than it should be. That creates the possibility of double taxation. The brokerage may issue Form 1099-R reporting the conversion or distribution. It may also issue Form 5498 showing contribution and account information. Those forms do not automatically establish that the original contribution was non-deductible. Form 8606 connects the pieces. The investor's tax return should reflect the contribution, conversion, existing basis, and relevant IRA values consistently. This is one reason the backdoor Roth should not be treated as an informal transfer between two accounts. It is a tax reporting strategy with a multi-year paper trail. An error may not become obvious until years later when additional money is converted or withdrawn. Correct reporting protects the after-tax basis, but even perfect paperwork cannot eliminate the pro-rata tax cost created by a large existing IRA. In that situation, the investor has several strategic options, and none is automatically best. An investor with substantial pre-tax IRA money has four broad options. The first is converting some or all of the pre-tax balance to a Roth IRA. This can eliminate or reduce the future pro-rata problem, but the converted pre-tax amount generally creates taxable income in the conversion year. A large conversion can push the investor into a higher tax bracket, affect Medicare premiums, or change other tax calculations. The second option is rolling eligible pre-tax IRA money into a workplace plan. When a 401k accepts incoming rollovers, this may move the pre-tax balance outside the IRA aggregation used for pro-rata calculations. The investor should compare plan fees, investment options, and withdrawal rules before making the move. The third option is completing the backdoor Roth and accepting partial taxation under the pro-rata rule. This may be reasonable when the pre-tax IRA balance is small and the resulting tax is manageable. The fourth option is delaying or avoiding the strategy. The investor may instead increase 401k, HSA, or taxable account contributions while preserving flexibility. The correct choice depends on the size of the IRA, the investor's current tax rate, expected future tax rate, and the number of years the Roth assets may remain invested. Paying $20,000 in tax to facilitate a $7,500 annual backdoor Roth contribution may not be attractive, but a strategic conversion completed during a temporarily low-income year may be reasonable for broader retirement planning reasons. The backdoor Roth should not force a large conversion that fails its own cost-benefit analysis. This strategy is also frequently confused with another technique carrying a similar name. The mega backdoor Roth is related in objective, but its mechanics and limits are completely different. The regular backdoor Roth uses individual retirement accounts. The investor makes a non-deductible traditional IRA contribution and then converts that money to a Roth IRA. For 2026, the standard IRA contribution limit is $7,500, or $8,600 for someone aged 50 or older. The main complication is the IRA pro-rata rule. The mega backdoor Roth uses a workplace retirement plan. It generally requires a 401k or similar plan that allows after-tax employee contributions beyond the normal elective deferral limit. The plan must also provide a way to move those after-tax contributions to a Roth treatment, such as an in-plan Roth conversion or an eligible distribution to a Roth IRA. The total annual additions limit for a defined contribution plan is $72,000 in 2026, before applicable catch-up contributions. But that does not mean every participant has $72,000 of mega backdoor Roth stays. The limit is shared by elective employee contributions, employer matching or profit-sharing contributions, and after-tax employee contributions. Suppose an employee contributes to the normal 401k limit and the employer adds a substantial match. Those amounts reduce the remaining space available for after-tax contributions. Many plans do not offer the required features. Others restrict the timing or frequency of conversions. The regular backdoor depends mainly on IRA structure and tax reporting. The mega backdoor depends heavily on workplace plan design. They share the Roth objective, but they are not interchangeable strategies, and neither should be implemented simply because it is available. The next question is whether the ordinary backdoor Roth produces enough value to justify its taxes and complexity. The backdoor Roth IRA may not be worthwhile when the investor can still make a regular direct Roth contribution. Adding a traditional IRA and conversion creates paperwork without creating an additional benefit. The strategy may also be unattractive when a large pre-tax IRA balance causes most of the conversion to become taxable. Solving that problem through a full Roth conversion can produce a tax bill much larger than the annual backdoor Roth contribution. Cash flow priorities matter too. An investor carrying high-interest debt, lacking emergency savings, or missing an employer match may have a better destination for the next dollar. The Roth tax benefit is valuable, but it does not automatically outrank every immediate financial need. The expected benefit horizon should also be considered. An investor planning to leave the money inside the Roth IRA for decades may receive more value from future tax-free compounding. Someone who expects to use the money soon may receive less benefit relative to the administrative work and potential taxes. The investor must also be willing to maintain accurate records. A backdoor Roth repeated every year creates recurring Form 8606 reporting and basis tracking. Someone unwilling to preserve those records may create future confusion. There is also an opportunity cost question. Would additional 401k contributions provide a current deduction? Would an HSA offer stronger tax advantages? Would a taxable brokerage account provide more flexibility? The backdoor Roth is available to many high-income investors. Available does not mean optimal. The strategy is strongest when the direct Roth route is blocked, the pro-rata issue is controlled, and the investor has a long-term reason to build tax-free assets. That combination leads to the final 2026 verdict. So, is the backdoor Roth IRA still worth it in 2026? Yes, for the right investor. The strategy can be powerful when income blocks a direct Roth contribution. The investor has eligible compensation and pre-tax traditional, SEP, and SIMPLE IRA balances are either small or properly managed. It becomes especially attractive when the Roth IRA can remain invested for many years and provide meaningful tax diversification in retirement. but the value depends on execution. First, confirm that direct Roth contributions are actually unavailable. Second, review every eligible IRA balance across every financial institution. Third, estimate how the pro-rata rule will divide the conversion between taxable and non-taxable money. Fourth, consider what will remain in those IRAs on December 31st. Fifth, report the non-deductible contribution and conversion correctly using Form 8686. Then, invest the money inside the Roth IRA. The strategy is a weaker fit when a direct contribution is still available, the pro-rata rule creates a large tax bill, or more urgent financial priorities need the cash. It may also be inappropriate when the investor cannot maintain the required tax records. The backdoor Roth does not create extra IRA contribution room. It does not erase taxes already embedded in pre-tax accounts, and it is not a special account protected from ordinary investment risk. It is simply a legal contribution and conversion sequence that can produce valuable Roth assets when the surrounding tax structure is clean. Understand the basis, control the pro-rata rule, check the year-end balances, complete the reporting, invest for the long term, and let boring money win.